All right, stock market analysis and projections. This is important information. Make sure you take time to read this slide. It talks about our approach to the market and about how you use our information with that important aspect of trade ownership. You must take ownership of your own trades. This again is what we saw just a little while ago. Matt did a great review of our day trader service and our market condition monitor, the MCM Pro, and you can test drive this now for free. All you have to do is go to askSlim.com, click the test drive button up on the top, and you will then be able to sign up and get this for a couple of weeks for free. You're just not going to believe how great this is. If you have any questions, write to Matt at askSlim.com. All right, stock market analysis, multiple time frame analysis and projections. That's what we do, multiple time frame analysis. We share with you the sum of the evidence when we come up with our projections based on the cycle rhythms, that is the money flows in the market, which we show to you in a visual way, using also our proprietary momentum indicators, and important support resistance zones. It's important to see how they act through those zones. And I'm going to also show you an absolutely crazy important comparison to the US dollar JPY and talk to you about why it is so important right now. We're going to start out by looking at our multiple time frame analysis. There are 4 charts up here. And that is weekly, a daily momentum chart right over here, and a 2-hour chart right there. So we're going to look at the SPY on the weekly. Now, we had talked about the SPY having a correction during this time frame. Now, that came from the cyclical patterns on the bottom, which essentially are money flows. This is how you see them. And there is a repeating average length or period, as they call it, for the cycles. And in this case, there's also a minor cycle in there. And I thought, because of the conditions of the market, that the minor cycle would have something significant on the downside in it, but not a bear market, but something significant in here. And I had thought that, well, in the crazy bullish case, it would be maybe only 3.5%, 4%. It could get down to 5.5% or more on the downside. And it's gotten to be a little bit more of that in that decline. If you look over here, the minor cycle right there in a bullish cycle, looks, not a lot different than this, but this was a bearish cycle where it broke that low back over here, and that set up a very, very bad situation back there when the market was in a bear market. So right now, we're just looking at this, and I want to remind you to go to the askSlim.com website, go to workshops. There's a free video there, and it talks about our cycle analysis workshop, and you can learn how to do this style of analysis like our expert team. So right over here, you can see these 2 timing lines says this is really where this bottom should come in. Now, I had some reasons to believe it was going to be in the first week of August, and that's more on the daily chart. But I want to look a little bit further out right now. And that is the period right in here, which is a potential for a large drop out over here, and maybe even a bear market that could form in this period of September, October, pre-election or after election right there. Here's your election date right there, November 5th of 2024. And I don't need to tell you about the politics that are going on right now and how any of that can't really be very exciting to the stock market and investors. So we may be done here on the downside, or we may get some further decline. The extreme area that is right here on the SPY is 520. This level right over here where it tagged today is about 528. You can see right there. Now, if I switch over to the daily chart, but first, there's something important I want you to know. See this downturn right over there in momentum? That is our reversal scout. That's a level 4 indicator here at askSlim. And that is a pretty important warning that there is weakness here. You can see this cycle right over here where it pointed to the downside for a correction. Look at this one right over here. This was so strong, the reversal scout could not turn down. But now it has turned down, and it tells you about the weakness that's in the market. And you have to be very skeptical of rallies now when they come. Here is the daily right now. And this daily, what we do is we build a slim cloud, is what we call it. And the slim cloud, let me just take it from this spot right over here. You could see that what we do is after the cloud has developed and it's finished, we put in the cycle lines, as you see right over here, and then we begin to build the next cloud. I had put out a warning that if it got under 542, if it really approached it, the market was going to be in trouble. Also, you can see in here, as it was moving up, this is our option bias study. And when it's up here at what we call P3, the market is in very, very good shape. And you could see as it continued to move up, the market was in good shape. This says, bias your option positions to the long side. It is now down over here. It says bias your option positions to the short side. That doesn't mean you sell right over here at the bottom. What it does mean is that when rebounds come, they're likely to fail. Now, this low right over here, you see that note early. That made no sense to me. It said to me that if we got a rally, it was likely to fail. Now, this is where that NVIDIA upgrade came and it got up here into the resistance zones. This is pretty anomalous. I mean, it's pretty reasonable to be looking at this level over here as a level that will probably be tested because it was so early, but that a rally would fail. So, we had looked at this and said, well, we may be entering that bottoming process. But still, there was time for this to fail and move down. And it came down over here and tagged this level right over here, which are supports off of the weekly that I just showed you. Let's go back to the weekly. You could see it tagging that support. Let's go back to the daily. Here's where it tags that support. Now we're in a time frame now, and I also have some intraday charts that help me time this also, that says to me there is likely a low going to form in here. So we're just entering into this bottoming process that comes in between these two lines right over here, where we start to look for signs that the market could make a bottom. Now, if the market did give us some signs of that, then I would be looking at projecting it out something like this. As you can see, I wanted to show you that alternative where we start to look for what the next cycle, how that next cycle shape will look as I build the cloud around this. So I wanted you to see that once this bottom is in place, I will have an anchor point. I'll be able to put in the resistance zones right in here that would suggest that the market will have a tough time at that level. Just as it had a tough time right over here, we'll have some resistance zones that say, well, that's probably the area it's going to rebound to, but I can't do that until I know where the low is in here and I have the anchor point. So when you go back to the weekly, you can see that, well, that's projecting to another rally. This is projecting based on the mechanical way that we do it, because this is a positive cycle right over here. And it says that the next half cycle is likely to get up and test this area. My gut tells me that's not going to happen and that it's going to fail more in the resistance area that we put up here on the daily chart. But that's just my gut feel from 50 years of trading and looking at these, and I trust my gut. So again, the momentum right in here, slim ribbon turning negative right here, the option bias indicator telling you that you should really still be thinking about biasing to the short side. This is a look at the momentum on the for the chart. No comparisons on that, so we'll move that off. And you could see the momentum in here as it was positive through here, and all of these upside momentum resumption signals coming, telling you the market was in good shape. You see way back over here in February, March, doing the same thing. And right over here, you now get this downside momentum signal that says expect resumption on the downside, which is what we saw. So a lot of weakness and a lot of reason to be careful about buying for a bottom in here, because we don't really see that we have it yet. Here's our 2-hour chart right in here, and that has the market condition indicator in there, which is a multiple time frame indicator. And when it gets down to this 25 level, it is doing a test. It is now down over here to the 17 level. If it crosses under minus 25, it will be a significantly negative signal. So we're watching for that right now. So again, there is your weekly, which says getting near the bottoming place, that it should be able to put on a bounce. I'm suspicious about what would be the normal rebounding magnitude that we have on there. This is what the projection looks like. Once we get this bottom in here, we'll be establishing where that area is. That is the resistance area. And if it sets up in a positive way right over here, like I have it drawn, and that's the expectation, that will then confirm that low right over there. And we'll be looking for it to continue waffling around over here until we get into that September, mid-late September period, where I think the risks really increase again. For those of you that missed my analysis on the interest rate markets, I show that where interest rate markets get very weak or the bond market gets very strong, those coincide with severe declines in the stock market. And that's one of the things that has me worried moving forward about the period just past here, past September. But once this bottom is in place, we'll be looking for that rebound right in there. So now I want to show you something else, because this is mind-boggling. I talked a lot about the yen and yen carry trade recently with our members. What's going on in the world right now is that for more than a decade, the negative interest rate policy in Japan has been financing the stock market and financing other markets. It financed the Japanese market. It financed the RAI craze as the markets got to an insane level. 200% of GDP is insane. And the market's backing off now from that, as you can see. What happens is that they borrow money at zero in Japan, and they take that money and they spend it elsewhere, and they invest in other assets. But the Japanese yen collapsed. And when that happened, I'm sorry, the dollar collapsed versus the Japanese yen. The Japanese yen spiked. And when that happened, investors, massive amounts of them, had to unwind the yen carry trade. So it's the reverse carry trade. They are short yen, which were moving up sharply, and they were long other things that they had to liquidate. Look at this now. This is a 2-hour chart of the US dollar compared to the S&P 500. And this takes you back over here to May 1st. I wanted to show you at least 3 months in here. As the dollar moved up and the yen was weak, the stock market was able to move up. As you can see going through here, this is the dollar strong, so the yen is weak. Dollar strong, so the yen is weak. Stock market financed by money they were borrowing in Japan. But look what happened after the dollar started to fall versus the yen, or the yen spiking to the upside. All of a sudden, the stock market got sold. Look at how this follows each other. If you're not watching this every single day, intraday, you're not understanding why the market's doing what it's doing. This big decline here in the dollar versus the yen shows you they're massively short in the yen. They're massively long other assets all over the world, and it forces them out of our stock market. This is your S&P 500 right over here as it fell from 5670 all the way down here to 5300. And that is a big problem for the stock market when the US dollar is weak versus the yen. So in other words, you either want to look at US dollar JPY, and when it moves down, the stock market has been moving down, or you want to look at the inverse at the futures of the Japanese yen, which will look just the opposite of this. I like to look at this one because it tracks it perfectly together. This is what's feeding the stock market decline exactly at a time, based on our work, that should be happening. So the question is, what about when this changes and the US dollar starts to rebound? Shouldn't that give you some kind of a rally? Well, let's take a look at that and see if that's the case and how long it should last. So we're going to look at US dollar, USD, JPY. We're going to switch these charts over to that. And now what we're going to do is we're going to look at the weekly, daily, and you can see something in here very significant based on our cycle work. Look at how gorgeous this is. And what happened after this cycle bottomed, of course, the dollar was going up versus the yen, and the stock market rallied to its peak right in here. Once the US dollar started to fall against the yen, all of those carry trade positions had to start to get unwound, and then you see the dollar plunging versus the yen. But if you look at the cycle patterns, this is a breakdown. That says that this cycle has peaked right over here, a left-hand translation, and that the yen is likely to continue moving down into where the monthly trough is aligned with the weekly trough. That says that rallies here in the dollar versus the yen, or pullbacks in the yen that bring a stock market bounce, is likely to fail, and that we're likely to see waves and waves and waves of decline in the dollar yen, and waves of decline in the stock market as it relates to it. And that is a very, very negative scenario for stocks. That's why I'm pointing in our analysis in the S&P 500 to a potential very large decline out over here, where this aligns with the stock market drop right there. This is a very negative scenario. And you can see in here, you know, this cycle over here turned negative, but it didn't break that cycle low with only till there was only 3 weeks to go. In this case, it did it with all of this period to go all the way out into November. And this is a very ugly looking chart, and very ugly for the stock market and other assets. Let's take a look here at the daily chart. And this is bad. Now, look over here. You see these two orange dots? This is our option bias indicator. It says that this is oversold and likely to bounce. Probably going to bring you a stock market bounce when this bounces right in here. But again, this doesn't point to really a low until out here towards the late August period. So the stock market might actually have a problem getting any kind of a real rally going into that period right now. That is a look there, and you can see that the slim ribbon, which was positive all through here, and telling you the US dollar versus the yen was strong, and to keep your positions biased over here on the long side, right over here at option bias indicator, this has now turned negative. Look at the momentum in here as it went from positive to neutral in all these cycles, and then turned negative right over here where the stock market started to decline. Again, we're looking at the dollar versus the yen right over here. And once this turned into negative momentum, it was a lot of trouble for everything. So I wanted to show you that because it is immensely important to you as an investor and as a trader. This period of dollar weakness that we're looking at versus the Japanese yen is early. There's a lot of time for this to continue. All of the rallies in the dollar versus the yen are likely to bring rebounds in the stock market, and they are very, very likely to fail because this is likely to keep moving down. Again, my S&P 500 analysis is that there is likely to be a minor bottom on this weekly cycle that forms in alignment with the bottom forming in here, and a period where the market looks a little better, but that in alignment with what I expect to see in the Japanese yen, Japanese yen spiking up and the dollar moving down, takes you out over here into October, and this very, very weak period there. We had somebody ask about the VIX earlier on, and I just want you to see this VIX pattern right in here, and this immense spike. This is where we were talking about the bottoms in here in these cycles and the possibility for a spike. I didn't really have it, you know, I said on the outside into the 20s, 30 would be a real panic. You could get in this period out over here into this October, November, 40, 50, 60s in the VIX out over there. So likely to get some period in here where the market has a stock market bounce and the VIX pulls down, but then it is very likely to be moving to the upside again. So that is a look at the stock market and the relationship to the US dollar JPY. I think it is just mind-boggling that how that is such important information in those comparisons, and how it warns you that after more than a decade of zero interest rate policy that we had here in the US that changed, then had money being borrowed like crazy out of Japan to finance all of these other bubbly assets in there, that is over with. And that's why you're seeing major tops forming in a lot of these high-tech stocks that were just absolutely wildly priced. If you caught a video a couple weeks ago, I showed how the Dow had now gotten up to a level that also was historic as far as its value compared to the GDP. Everything that was those flight to safety, everything that was coming out in money wise out of the tech stocks as this peak was being made, and then moving into small caps, mid caps, Dow, all of those, that also has changed as valuations got too high for those also. Going forward, we may see a period where the small caps, mid caps start to do better again. Well, of course, we'll be showing those to our members.